Okay, good evening, class, and welcome to our advanced tax class this evening. Today we'll be talking about taxation of business income. We'll be looking at double taxation relief. Now, when we say double taxation relief, we're talking about businesses or individuals that are Nigerian residents but are earning foreign income. So how will a Nigerian resident earn foreign income? They may be multinationals. By multinationals, I mean that they have presence in different countries. And so because of that presence in different countries, they trade and they make foreign income. Now, because they are Nigerian companies, they are going to be taxed from their worldwide income. And so in taxation, residence plays a major role in determining the tax of an individual or a company. So the question is, who is a resident and who is not a resident? Now, a resident is someone who resides in Nigeria for 183 days or more in a 12-month basis period. So as an individual, your basis period is actual year basis. That means it starts from January 1 down to December 31st. So if cumulatively an individual earns income in Nigeria for 183 days or more, that is give or take 6 months, you are a resident. So let's give this scenario. Let's say Nigerian Super Eagles have a foreign coach from Germany, and this German guy is not a Nigerian origin anyway, but he stays here in Nigeria for like 6-7 months to coach the Nigerian team. Is he a resident or a non-resident? Yes, of course, he is a resident because he has stayed up to 183 days or more earning income in Nigeria. It doesn't matter if he travels, maybe he stays in Nigeria, let's say 2 months, he traveled maybe 1 month and comes back again, stays 2 months. travels, come back again, stay 1 month, travels, come back, stay 2 months. As long as during the January to December period, he stays cumulatively 183 days, he is a resident. Now, another thing that makes him a resident is that another thing that makes him a person a resident is if you are representing Nigeria in another country. Let's say you are an ambassador of Nigeria for United States. And so you are not in Nigeria, you are not domiciled in Nigeria, but you are an ambassador for Nigeria in United States. Now, that means you are a resident because that ambassadorship is seen as a Nigerian soil. So you are still a resident. But a United States ambassador in Nigeria, even though he stays 4 years, is not a resident. Now, when it comes to companies, what makes them resident and non-residents is incorporation. And so if a company is incorporated in Nigeria, the company is a Nigerian resident. And so let's say Glow Nigeria, registered, incorporated by Kama, Nigeria, registered in Nigeria, but has presence in Ghana, South Africa. That company, wherever it is in the world, is a Nigerian resident company. Okay, now look at MTN Nigeria. MTN was registered, incorporated in South Africa, and so they may have presence in Nigeria. Now, because they have presence in Nigeria, that doesn't make them a Nigerian company. They are foreign companies. And so they are not seen as Nigerian residents. MTN, MultiChoice, you name them. Now, in this our topic for today, we are going to be looking at Nigerian resident companies that are earning foreign income. So you'll be thinking in the likes of Glow Nigeria, okay, and maybe other multinationals that are registered in Nigeria, but are earning foreign company. In a future topic, we'll be looking at special businesses that is a foreign company resident in Nigeria. So you'll be looking at the likes of MTN, MultiChoice. They are foreign company residents in Nigeria and being taxed in Nigeria. So when we look at double taxation, let your mind be going to Glow Nigeria. When we look at special businesses, especially in the communication industry, let your mind be going to MTN. These are examples you can use to differentiate it. Okay, so now that we've seen the scope of our lecture today, let's look at double taxation agreement and double taxation relief. Now, what is double taxation agreement? Double taxation agreement is this agreement that Nigeria enters with other business partners it is having a business with. You know, some of the Nigerian companies are domiciled outside Nigeria, and so they know that they are doing business with Nigeria. And so Nigeria goes into agreement that based on reciprocal basis, they are going to be giving relief to Nigerian people who are outsiders. And so these countries will also give relief to foreigners who are in Nigeria. Okay, So when there is a double taxation relief agreement, then there is a double taxation relief that is clearly followed, clearly spelled out. Then there is section 34 and 35 of the CITA, Company Income Tax Act. It deals with where there are specific agreements, that is when there are double taxation agreements. While section 33 of CITA deals with when there is no specific agreement. So when Nigeria is dealing with another country where they have no double taxation agreement, section 33 deals with that. So now let's talk about section 34 and 35 before we go to section 33. Now, double taxation agreement. When a country or a businessman does business in a foreign country, he is going to be charged tax in that company. Let's say in South Africa, he's going to be charged tax there. So I'm using Glo as an example. Glo does a business, is charged tax in South Africa. Now, because he has been charged tax in South Africa, he's going to bring the whole of the income. So let's say 1 million naira equivalent was the income made in South Africa. And the South Africa perhaps would have charged, let's say, 25% tax. Glo Nigeria will still bring the whole 1 million naira in record to Nigerian soil. That is what we call repatriation of the income in Nigeria. Now, we want to take note that the South African government have taken their own tax. Nigeria will now look at Glo's Nigerian books and also impose its own tax, say 30%. But why would they want to tax 30% again when South Africa had taken 25%? Is there any way they can cushion the effect so that Glo Nigeria will not end up paying 55% tax? Well, that is where the double taxation agreement comes in. So the double taxation agreement states that whenever there is a double taxation agreement, the relief will be computed based on the provisions of that section 34 and 35. Now, look at what you should know. First of all, if you are answering a question that has to do with double taxation agreement, look at the question. If there is a double taxation agreement stated in the question, just underline it. Underline it and say, yes, there is a double taxation agreement. Why is that important? It will save you a lot of time. If there is no double taxation agreement stated explicitly in the question, then assume there is no double taxation agreement. Because if there is an agreement, the question will state it. So the first thing to do when solving a question that you suspected to be double taxation agreement is to check explicitly if there is double taxation agreement. If there is, underline it. If there is none, assume there is none. The second thing to do is to check if the company is wholly Nigerian company. Of course, it has to be a wholly Nigerian company for this to take place. So when there is a wholly Nigerian company that is having double taxation agreements, you have to look for two things. One, look for the foreign tax. How will you know the foreign tax? It will be given to you. It will be given to you. Now, when you look for the foreign tax, it is also good to look for the foreign tax rates. How do you look for the foreign tax rates? The foreign tax rate, excuse me, is simply the foreign tax divided by the total income. The foreign tax divided by the total income times 100. Of course, you know that it is a percentage of the total income that you pay as tax. So if you want to know your tax percent, you have to say foreign tax divided by total income times 100. That gives you your foreign tax percentage. Then you now look at your Nigerian tax rates, because it's 30%. Now you have to compare the foreign tax rates in percentage with the Nigerian tax rate in percentage. Whichever is smaller, that is the rate at which will be used for the relief. So let's say the percentage that the South African government gave to Glo is 25%, and Nigeria is having 30% as a tax rate. So when Nigeria computes its tax, it's going to give a relief equivalent to 25% of the foreign income. So it means that that's 25% that was taxed in South Africa. That is what will be used as the relief. For assuming that South Africa charged like 33% to 35%, that means the 30% in Nigeria will also be used as a relief in Nigeria. So just give me a moment, please. Okay, so we are good to go. Okay, so we are saying that the Nigerian company will compare the tax rates of the foreign company with that of Nigerian company, and they will choose the smaller rates. That's the point you have to take. Now, the essence is that Nigerian cannot grant you much more than Nigerian tax. So it means that if you suffer tax in Nigeria and you suffer tax outside, the relief you are going to get will not be more than Nigerian tax. The highest you can get as a relief is to be relieved all of your Nigerian tax. That is, if Nigerian tax rate is smaller than the foreign tax rate. So you see, if if the company has like three different countries, apart from Nigeria, let's say you have 2 other countries, you have to be doing them in turns. You take Nigeria with, let's say, South Africa, you deal with that one with South Africa, you take again Nigeria, maybe with Ghana, and you deal separately with each of them. So you don't go, and if they give you 3 countries, because it might come out in exam, you don't go taking the whole 3 and then use the smallest of them to do relief in all of them. No, you are taking them case by case. You take with Ghana, you compare it with Nigeria, you relieve that of Ghana's income. You take South Africa, you take it on its own merit, and you relieve their own. So that is how it is being done. So things to note again is that any claim for allowance by way of credit shall not be made later than 2 years after the end of the assessment year. So the assessment here that it relates to, if you want to still get credit, it should not be more than 2 years when you are applying for the credits, the double taxation credit. It should not be more than 2 years. All right. So by way of summary, when you are dealing with double tax, first of all, look out for the fact that it's a wholly Nigerian company. Look out for the fact that there is specifically spelled out double taxation agreement. Thirdly, look for the foreign tax, then get the foreign tax rate. How do you get the foreign tax rate? You have to deal with the accounts and you get the total income. When you get the total income, you look at foreign tax divided by total income times 100. That gives you your foreign tax rate. This is what you'll be using to compare with Nigerian tax rates in percentage to see which one of them is smaller, and that is what you will use to exercise your relief. Now we go to section 33 that deals with no double taxation. So you can easily know that there is no double taxation because they may not tell you anything about double taxation agreement, or you'll be seeing language such as Commonwealth relief or Commonwealth income tax. So now when you see Commonwealth income tax and all that, you know that is the Commonwealth principle is coming into play. So what do you do in this situation? One, it is only for Nigerian companies that are only Nigerian companies, yes? Secondly, what you need to do is to look for, just a moment, please, let me on my mic. Okay, sorry. Now we are looking at when there is no double taxation agreement. You look at it that yes, Nigerian company, look at the things you are going to look at. One, look at the company that is given to you. If it is a company that is resident in Nigeria or resident outside. Then secondly, look out for, okay, let's look at section 1 here. Look out for if it is resident outside Nigeria. Then secondly, look for Nigerian tax rates, the foreign tax rates. Then you look for half of Nigerian tax rates. So take note, you look for the foreign tax rates, you look for Nigerian tax rates, then you slice that of Nigerian tax rate into half. Why are you slicing it into half? Because there is no agreement they cannot be enjoying the same thing with those who have an agreement. And so those who have an agreement, the maximum they can be relieved is the whole of Nigerian tax. But if you don't have an agreement, the maximum you can get as a relief is half of Nigerian tax. So you are going to look at the foreign tax, which you will call Commonwealth tax rate. You will now look at Nigerian tax, but of course you would have sliced it into half, and so you'll be comparing half of Nigerian tax with the Commonwealth rate. So what you'll be saying is, if the Commonwealth rate of tax is smaller than half of Nigerian rates, of course, it is the smaller one we are going to use. We are going to use the Commonwealth rate. But if on the other hand, the Commonwealth rate is higher than half of Nigerians' rate of tax, then we are going to be using half of Nigerian rate. So that's the advantage of having a double taxation relief for Nigerian companies. They are going to, fortunately, they are going to get at most, all of Nigerian tax payable as relief. But for those that do not have a double taxation agreement, the maximum they can get is half of Nigerian tax rates as a relief. Now, that is for Nigerian companies that are domiciled outside, which is like Glo, for example. Then when it comes to subsection 2, this is for non-Nigerian companies domiciled in Nigeria. Normally, this does not really come up in exam, and this does not really apply so much. This is because the taxation of special businesses have taken care of this. So, but for the purpose of this class, we'll still talk about it. For non-Nigerian companies that are domiciled in Nigeria, okay, we cannot tax all their income, only the income that they happen to make in Nigeria. So what happened is that if you find out that it's a non-Nigerian company, we can only tax Nigerian income. So if it happens that they have been taxed outside in their home company, their home country, before Nigeria wants to tax them, then that is when this applies. You look at the Commonwealth rates of tax that has been taxed them, then you look at Nigerian rate of tax. Then what you will now do is you will slice the Commonwealth rate of tax by half. Remember, for Nigerian company, you slice Nigerian rate of tax by half. But for foreign company, you slice the Commonwealth rate of tax by half. So what you do is you'll be comparing the Commonwealth rate with Nigerian rate. Mind you, you have slashed it by half, but you are not comparing Commonwealth rate, which you have not sliced, with Nigerian rate. And so if the Commonwealth rate is bigger than Nigerian rate, then what will happen is the amount by which Nigerians rate is bigger than half of the Commonwealth rate is what will be charged. Let's take, for example, the Commonwealth rate is 20%, and Nigerian rate is, Commonwealth rate is 40%, then Nigerian rate is 30%. You can see clearly that 40% is higher than 30%, right? So what you will do, that half of 40% which you have separately, you will compare it with Nigerian rate, and you say 30% is bigger than 20%. So you say the difference between the difference between that Nigerian rate and the foreign rate, 20 and 30, that is 10. That is what you are going to be using as the rate of tax. But if we find out that the Commonwealth rate is smaller than Nigerian rate, let's say Nigerian rate is 30, Commonwealth rate is 25, or let's say 24%, and Nigerian rate is 30. All you now do is you will say 1/2, excuse me, so you will say 1/2 of Nigeria, 1/2 of, sorry, the Commonwealth rate of tax is smaller than Nigerian rate. If it is smaller than Nigerian rate, then we are taking 1/2 of the Commonwealth rate. So let's look at it again. Nigerian rate is 30%, Commonwealth rate is 24%. Clearly, Nigeria is bigger than Commonwealth. You will take half of the Commonwealth rate, which is 24. 24, you take half of it, which is 12. That is what will be used as your relief. But going back to when the Commonwealth rate is bigger than Nigerian rates, you look for the difference between Nigerian rate and 1/2 of the Commonwealth rate. Well, it has usually not been common in exam, but who knows, it may come up in any exam. Okay, so what are the impacts of double taxation relief? Impact of double taxation relief. So you write relief here, double taxation, there's supposed to be a relief here. One, it helps to avoid double taxation. So double taxation is when you are charging one income 2 times. This is different from multiple tax. Multiple tax is when a taxpayer is facing different tax from different tax jurisdiction, different tax kind of taxes. But double taxation is the same kind of tax, income tax, being charged double in 2 different jurisdictions. That's double taxation. So it helps you to avoid double taxation. Also, it helps clarifying taxing rights of each state. Okay, the taxing rights of Nigeria, the taxing rights of those foreign company. This double taxation agreement helps to clarify their taxing rights. Then it encourages economic cooperation between states. Okay, so there is something that they call automatic exchange of information. This automatic exchange of information, it's where 2 or more countries come together to cooperate to provide economic information about companies in their states. Not naturally, Nigeria has joined that starting from this September. Nigeria has joined, and every September of every year, there will be this economic and automatic response. So before 30th of September, Nigeria will get this economic reports from all the other places where Nigerian companies are doing businesses. So it helps to get information about the activities of companies so that they will better able to assess their taxes, give them good assessment, and tax them appropriately. Okay, prevention of fiscal evasion with anti-avoidance provisions. Okay, evasion of tax is where you don't want to pay tax. You don't want to pay tax. You are running away from tax, not legally, illegally, by bringing what they call anti-avoidance provision. You bring certain things that does not have economic value and you want to use it to avoid paying tax. Okay. Then it also helps in lowering compliance costs. Compliance costs have to do with going around checking that you have complied with law and all that. So if there is no double taxation agreement, the cost of compliance will be too high because it may require the tax authority traveling to the places where they have businesses to go and verify and all that. So, but since there is a double taxation agreement which is spelled out and everybody knows their taxing right, their taxing rate and all that, the cost of compliance, so to speak, is now lowered. So they won't spend much in order to get the information that they are requiring to get. So you see here now that we are in this topic, we are mainly dealing with Nigerian companies earning income outside. Like as I said before, subsection 2 of section 33, it also has a bearing to do with foreign companies, special businesses too. So there may be some businesses that are not classified as special businesses. Now, these are the kind of businesses that are falling into here. Those ones that are not classified as foreign businesses or as specialized businesses. Those are the foreign companies that are talked about in this subsection 2 of section 33. Of course, when we talk about foreign special businesses, we talk about airlines, we talk about communication company, we talk about insurance, we talk about agriculture, we talk about what again? Unit trust, name them. So those ones that are outside the scope here and they are non-Nigerian companies, but they are in Nigeria, then this section covers them. Let's look at a question to see how we can resolve this double taxation agreement. Now, exercise 3.1. Salim Consultants Limited 12. Now, this incorporated date is not too important in our tax calculation, but there comes a time when we look at it. But for now, this incorporated date is not important. It's a firm of corporate advisors resident in Nigeria. So you see it was highlighted here, resident in Nigeria. So it means here that the incorporation that was done in 2012 was in Nigeria. So it was registered in Nigeria. So when it is registered in Nigeria, it means it is a Nigerian company. So now you've seen one of the ingredients. It is registered in Nigeria, resident in Nigeria. It shows you that it is incorporated in Nigeria. Okay. In 2015, so of course you will be doing preceding year basis. In 2015, it expanded to Burundi. Burundi is another country to tap into the booming business opportunity in that country. Okay. The directors have heard of double taxation agreements. Okay, they have heard of double taxation agreements. So let's underline that. Okay. With the attendant benefits, or even though the company has never been a beneficiary, the directors, being highly educated executives, have tried on their own to read about and understand the concept of double taxation agreement and its attendant relief, all to no avail. Okay, they're just trying to tell you stories here, so let's leave them. Below is the summary of the income statement for the year ended December 31, 2016. So after 1 year, they have tried reading. Now this is their statement, okay? So, you know it's going to be a preceding year basis, so it's going to be 2017 year of assessment. Now look at Nigeria and look at Burundi, okay? Now, this total here, this Nigeria here, represents the activities done only in Nigeria. Burundi here represents only the activities done in Burundi. What about this total? This total is a consolidation of Nigeria and Burundi. So when we consolidate them, who will have the consolidation? Nigeria or Burundi? It's going to be Nigeria. Why? Because it is resident in Nigeria. So this total represents Nigeria. Okay? So if you look at it again, gross advisory fee. So these are the gross amounts that is being paid. Look at other incomes here. Now look at the total income gotten. Then look at the expenses. Deal execution expenses, office rent, depreciation. And of course, when you reach at depreciation, you know this depreciation is not allowed. You know this depreciation is not allowed. So without reading additional information, you've started thinking this thing is not allowed. So why are they allowing it here? So loss on sale of non-current assets. What do we talk about it? Loss of sale, loss that you got when you sold your non-current asset. It's not an operational sales. It's not an operational activity. So this has no business here. It is not allowed. Foreign exchange loss provision, other operating expenses. Okay. All right. Now look at the operating profits. Look at the operating profits. Okay. Now, they now said the sum of 2.130 million was paid to the Burundi tax authority for the year. So this tax has already been paid. Now, there is something you should know. This tax that has been paid here will be used to divide the total profits to get the tax rates. Okay, so for now, we don't know the tax rates. Secondly, this tax here is in the additional information and it's not inside of this account. And so there is no need for us to add it back again because from here, it was not deducted here. So now they said they claim this amount as their capital allowance. Okay, so they paid this tax after they have claimed this allowance. Okay, so what we do now is allowance claimable in Nigeria is 7,800,000. So this is 7,800,000. Okay. So we are not talking about other income. So they now brought our attention to other income. In the other income, they said 96,000, 960,000. So let's look at it. Okay, 960,000 is for Nigeria. Yeah, is profit from the sale of non-current assets. Okay, so you see if we have to disallow loss on sale of current assets, if we have to disallow loss, so that means we are going to also disallow this profit, because this profit is not an operational profit. It's other comprehensive income. It's not your income from operations. So we are not going to allow it. So we are going to deduct it. And they said, why this 1,800,000, which is this here, is gains from disposal of securities. Your securities is your financial, that has to do with your financial raising of capital and all that. So these are not operational expenses. These are capital expenditure, capital income. So capital income is not operational income. So this one will also be deducted, and so give or take, this line will not exist. This line will not exist in the new account. So we are going to be looking at how we can adjust this statement. How we can adjust this statement so that we'll be getting the real deal. It depends on how you want to start. Some people want to start from the top and do the right thing. Some will want to start from the bottom and start adjusting. So it depends on whichever method you feel like, and whichever has fewer workings for you. Okay? They said, as a tax practitioner, so now you are like working for the government, or you're looking at it like in the eyes of the government, or you want to help your clients now. You want to help your clients see things from the eyes of the government. Compute the double tax credits claimable by the company. Okay, the double tax credit that will be claimable is anything that is paid as tax in Burundi when they are paying tax in Nigeria. That is when they are going to claim it. Assuming there is, so you see the main thing here, there is a double taxation agreement. So this is what you should underline. You know, from here I told you about double taxation agreement and all that. I told you to underline it there. They have not explicitly stated that that double taxation agreement exists, but you know, from there you may need to know that yes, why they are interested in it is because it's possibly that double taxation agreement is stated. But here it is stated specifically there is a double taxation agreement. So let's go over the steps we need to do. One, we need to check if there is a wholly Nigerian company. Check if there is a double taxation agreement. Yes. Check for the tax foreign tax rates. This is what we are going to do. Then we are going to find the relief that is claimable by the company. Okay, let's work at it together. Now, we'll start with the net profit that was given to us. The net profit is this figure here that was given to us. So let's start the adjusting, okay, which is this figure total here. Now, what do we need to do? We were told in workings 2 that these profits need to be adjusted. We said they are not supposed to be included. And so they have been included here. So we are going to remove them. When we remove them, when we remove this one here, this is sale of non-current assets. This other one is gains from disposal of securities. So this is what we have gotten so far. So it's as good as going backward. So this is what we've gotten so far. Okay, so from the income, we've removed this income that is not supposed to be taxed. Okay, now let's look at the expenses that has been deducted already. Expenses that has been deducted already that we need to add back. So what happened? We need to add back those expenses. For example, let's see depreciation. Depreciation was deducted. We are adding it back. Then we talk about the sale of non-current assets. We are adding it back. Now, the next thing is tax is not here, but tax was here. But we need to add tax because why do you want to add tax? Because we want to get the picture, the full picture of what our assessable profit was before the tax was suffered. So they have already charged tax. We want to know the picture of what our assessable profit was before tax was charged. This is not to say because tax is a disallowable expenses. Tax is not disallowable, but we want to know what the picture was. In fact, it will also help us to calculate what our taxable profit was from where we paid our tax. So all the things that we are not supposed to remove, we are going to remove them. All the things that we are not supposed to remove that has been removed, we are going to add them. So that's what we are doing. But tax alone, we are adding it because we want to know the true position. So you add back your foreign tax, you get your assessable profit here. After getting your assessable profit, then you less your capital allowances that was given to you, the additional information, because of course assessable profit less capital allowance is what will give you your taxable profit. So you see, this is the taxable profit from where you paid your tax. So mind you, you are adding your tax back that was suffered. So whether it is stated in the body or stated outside, you have to add it to get the true picture of your assessable profit. Then you less your capital allowance to get your taxable profit. So this is the 100% taxable profit. As at this point here, tax has not been paid, so to speak. So let us find out the percentage of tax that you paid when you paid this 2,130,130. So you simply say 2,130,000 divided by 7,275,000 multiplied by 100. And when you do that, you are going to get 29.28. 29.28 is still equivalent to this amount of tax that you have paid here. Okay? So this is the tax payable in Burundi. Now, as I told you, this total belongs to Nigeria. When looking for Nigerian tax, you do not look at just this. You look at the worldwide. So, in case you are having like 2 or 3 countries, when you merge all of them together, you get Nigerian total tax. All you will be doing is to get a relief from any of the company from Nigerian tax, not from this only Nigerian situation, but from the worldwide income because it belongs to Nigeria. Okay, so this is what Nigeria is supposed to pay. The tax is supposed to pay in Nigeria is 30%, which is this amount. So what happened? The double taxation relief will be you compare this percentage with this percentage, whichever is smaller. Look, you're not comparing this amount and this amount. No, it's the percentage you are comparing. Because if you are to compare this amount, then why did we do all of this? Why did we do all of this? Why will we take the pains to add back all these? We wouldn't have done all of these. All we would have just done is just to get this and probably get this. So we took pains to go and get the total of all these so that we will look for the rate. It's the rate that is important to us. So we take this rate versus this rate. And since this one is smaller, we are going to take this rate from this amount here. So that's the same thing we did here. Excuse me. Okay, so sorry. So when we look for the smaller rates with the foreign companies' income, we are still getting the same thing. So this is the amount of relief that is still relieved. So all in all, whenever there is a double taxation agreement, you find out that the company gets relieved of the smaller tax. The company gets relieved of the smaller tax. And so this is the final tax that is payable in Nigeria. The final tax that is payable in Nigeria. So what the person have done is this. Let me explain this now. He has paid this amount in Burundi. And so he cannot be paying all this again. So in order to avoid double taxation, they remove what he has paid in Burundi because it's smaller, and this is what is left to pay in Nigeria. If you want to confirm, you add this plus this, you are going to get this. So that is how we are going to do it when you have foreign company, Nigerian company earning foreign income, as in this case here, and there is a double taxation agreement. Okay. So let's look at another question to see if there is no double taxation agreement in this second question. Explain what you know about double taxation treaty and Commonwealth income tax relief. Okay, then B, coming. Okay, now look at the answer to the A part. Whenever a foreign currency is earned and repatriated to the home country, there are tax implications involved. And this implies that the foreign income earner pays a tax both in the place his business is domiciled and in his home country. That is double tax. When Nigeria have a double taxation treaty with any country, there is a relief that the foreign income earner enjoys. That is that Nigerian company who is a foreign income earner. The double taxation relief is granted in accordance with the provisions of the double taxation agreement. Hence, the tax relief enjoyed will be lower than the local tax paid or payable and the foreign tax paid or and the foreign tax paid or payable. If, on the other hand, there is no double taxation treaty and thus no double taxation agreement exists, there is an equitable way of preventing the foreign income earner from paying too much tax. The income tax relief will depend on whether the company is incorporated in Nigeria, hence called the Nigerian company, or the person is a Nigerian resident, so to speak, or a foreign company or foreign person. This is called the Commonwealth Principles. It holds as follows. Nigerian company, if the Commonwealth rate does not exceed, that means it is smaller or equal to 1/2 of Nigerian tax rate, the double taxation rate will be the Commonwealth tax rate. Otherwise, if it exceeds 1/2 of Nigerian tax rate, then the double taxation rate will be 1/2 of Nigerian tax rate. Then for a non-Nigerian company, if the Commonwealth rate of tax does not exceed Nigerian rate of tax, the double taxation relief will be 1/2 of the Commonwealth tax rate. Otherwise, if it exceeds, the double taxation agreement will be the amount by which Nigerian rate of tax exceeds 1/2 of the Commonwealth rate of tax. Okay, let's see how we're going to do it in part B. In part B of the question says, John Okafor and Company Limited is an accounting firm based in Lagos. It was incorporated in Nigeria, so this tells you it is a Nigerian company. It has passed one test in the year 2000. In 2007, the company extended its operation to London. So London is a foreign branch. Any foreign income which will be repatriated in Nigeria. That's beautiful. The result of the business operation for the year ended 31st December 2007. Of course, you know it's going to be 2008 year of assessment. For both Lagos and London transactions, we are as follows. We have the Lagos office here. We have the London office here. Who gets the total? You're right, Nigerian company. All right. Now let's look at it now. We are looking at professional fees. These are allowed. This is a consulting firm. Professional fees are allowed. Consulting fees, total income, that's fine. Less expenses, we have the salaries, okay. Electricity and rates, that's fine. Motor vehicle maintenance, beautiful. Depreciation of assets, no, no, no. Other administrative expenses, we have to check if there is any statement that says there are some disallowable. Otherwise, we assume allowed. Bank charges and interest charge paid, allowed. Foreign tax suffered. It was deducted here, so we have to add it back to get the position that we were before we pay tax. Other miscellaneous expenses allowable. They call it allowable, let's believe them. Total expenditure, this has to be adjusted. Net profit, we have to adjust it. All right, required. We are required if the capital allowance agreed with the FIRS was this amount. Of course, you know, we have to less our capital allowance in place of depreciation. Okay. Compute the double taxation relief applicable to the company and the final tax payable. Okay. If there is a double taxation agreement between Nigeria and London, if no double taxation exists. So we are going to be doing two situations again. Let's see how the situation will play out. The situation will play out when there is double taxation agreement and then when there is no double taxation agreement. So we'll see the difference. Okay, so let's see the first one here. So we are given the net profit. We start from the net profit, okay? And we are adding back We are not deducting because one, these professional fees and consultancy fees are allowable. So nothing happens to the income. So we are not deducting income. So we're only looking at the expenses. One of the things we're going to add back here is depreciation. And so here we've added back our depreciation. And the next thing we're going to add again is foreign tax suffered. We want to see the situation of things before we paid our tax. And so what we now have here is accessible profits. So this is your accessible profit. Now that we've gotten our accessible profit, it's time to remove our capital allowance. In the question, agreed with the FIROS. So this is Nigerian income here. This is Nigerian capital allowance. So we were not told if it was paid by the foreign company, but some people might argue that it was paid by the foreign company, and so you can come and remove it here and also remove it here. But it was not explicitly stated, so I took this position that it was removed only in Nigeria. So it was taken that as if they look at the whole thing and remove it from here, and none was removed from London. So can you see that your London income here now becomes higher than the total income because no capital allowance was removed here? Another way of doing it is to prorate this capital allowance. Well, I didn't do that. I didn't take that stand, but you can take that stand. So I've told you two things you could do, which I didn't do here, but it's allowed. One, you can assume that because they said it was agreed with the FROS, it may be that it is London office capital allowances that was agreed with FROS. So you can repeat it here. But the best is, if you're in doubt, prorate it according to the accessible profit. So all you need to do is, all right, for you to get that of London, you will say this figure divided by this figure multiplied by this, you will get what will be here. And for Nigeria own alone, you don't need to even do Nigeria own again, because Nigerian own will be the total here, while the London own will be proration of the two of them. Okay. So I didn't do that for some purpose. I took this decision. So anyone you took, you stand by it. All right. Now look at the foreign tax suffered. The foreign tax suffered is going to be the foreign tax rate, rather, is going to be the foreign tax suffered, which is this, divided by the foreign rate, accessible total profits of the foreign company multiplied by 100. So it's going to be this. So you see that we've gotten 30.64 as our foreign tax rate. Now look at Nigerian tax rate is 30%. So which one is smaller? Nigerian tax rate is smaller. And so the relief. Now look at what they are supposed to pay in Nigeria now. They're supposed to pay 30% of this figure in Nigeria as their tax rate. So that's what we did here. 30% of this. This is what we are supposed to pay in Nigeria. This is what we are supposed to pay in Nigeria. But now the rules to apply is this. If the double taxation agreement exists and the foreign tax rate is greater than the Nigerian tax rate, then the double taxation relief would be charged at the Nigerian tax rate. So since 30% is smaller than 30.64, we are going to use 30% of this foreign profit to find how much is the relief. So we look at 30% of this, and we got something to be 1,478,400. Can you see that this is what they are supposed to relieve, and this is what they are supposed to pay as tax in Nigeria? Okay, we have another problem. So we have another problem. So because we have this amount here, still smaller than the relief, that means we are still going to relieve just this amount, because you cannot relieve in Nigeria anything bigger than Nigerian tax. So this relief is still bigger than Nigerian tax. So in as much as you are using 30% on the foreign income and you are still getting something bigger than Nigeria, you are going to be relieved, restricted to this amount. So this is the amount that you are going to be relieved in Nigeria. So you end up not paying any tax in Nigeria, all of them going as relief, while you are only paying this amount here in the foreign field. Okay, so look at the tax liability here. Look at London, look at the profits, look at the tax payable, look at Nigerian profit, look at the tax payable. Can you see that the relief, we cannot be giving that 1 point something, although we have calculated our relief to be 1,478,400, but we are still going to use Nigeria because it's not going to be bigger than Nigeria. So final, you're not going to pay any tax in Nigeria. We believe this is so clear. Now, I want to look at the second one here. Let me look at the second one, where a double taxation agreement does not exist. So we come to that same situation here. We do the same thing as we did as first, and we got all these figures. We did our foreign tax rate, and we have this same position here. Okay, now we are comparing this. We now bring our Nigerian tax rate, which is this, and we now bring 1/2 of Nigerian tax rate, which is this. Now we are going to be comparing. The rule says if a double taxation agreement does not exist, and the foreign tax rate, which is also called the Commonwealth rate, is greater than 1/2 of Nigerian tax rate. So you can see that 30.64 is greater than 15, then the relief would be at 15%. So you can see clearly that this half of Nigerian tax rate is lower than the foreign tax rates. And so we are going to enjoy the relief at 15%. And so we are going to look at 15% of the foreign. We are going to look at 15% of the foreign tax profit and taxable profits. So look at 15% of the foreign taxable profit. This is what we are supposed to give as relief. So let's work it out. Let's come back here. Taxable profits, the same thing we had before. This is London. This is Nigeria. This is the tax that is paid in London. This is what is supposed to be paid in Nigeria. Now, what is the relief that is going to be enjoyed? This is what we are going to enjoy as relief. And so the difference here is that in Nigeria now we are not paying 520,200 because there is no tax double taxation agreement, as against when we had a taxable agreement, double taxation agreement, they are paying 0 naira. So you see, it makes sense for Nigeria to have double taxation agreement with different countries so that they can help the economy of Nigeria. They can reduce the taxes they pay to Nigeria, encourage them to earn more foreign currency, more foreign income, bring them into Nigeria, develop Nigeria. So you see one of the advantages of Nigerian tax double taxation treaty with other foreign companies, foreign countries, it helps them to encourage businesses to thrive. So far so good. This is what we can learn today. So let me give you the summary again. If you are given a question that has to do with foreign double taxation treaties and all that, the first thing to do is check if it is wholly Nigerian company or if it is a foreign company. If it is a Nigerian company, then you have eliminated section 33, subsection 2. Secondly, you check if it is domiciled outside. If it is domiciled outside, it's between section 34 and section 33, subsection 1. You check again. The next thing you are looking for is, you're not reading all the questions anymore. You are looking for if double taxation exists. If double taxation exists, you've saved yourself a lot of stress. You go back and read the question. If double taxation does not exist, also save yourself from stress. Go back and read the question. Now, if double taxation exists, what you are looking for now is just how to get foreign tax rates and Nigerian rates to compare. If double taxation agreement does not exist, you are looking for three things: how to get the foreign tax rates, how to get Nigerian rates, and half of Nigerian rates. Then you start doing your comparison. All in all, there are certain things you do in common. So before you even start looking at all of these, you have to adjust your profits. So you can start adjusting your profits until you get your total profits, so to speak, before you start going to look for all these. In everything you do, you must still get your foreign tax rates. You must get your foreign tax rate in everything. So before going to look at all of these, start your adjustment, because that's what going to give you mark. Start your adjustment, get up to total profits. After getting total profits, get the total foreign tax payable, foreign tax rates. After getting the foreign tax rate, get your Nigerian tax rate. Once you have gotten these two, go and look for it. The question, if they tell you double taxation agreement exists, if it is existing, then that's the two rates you need. If you go and look and they say double taxation does not exist, you need your half of Nigerian tax rate. Then you start operation. The operation is to look at which principle to apply, which of the principle to apply. Okay, so if double taxation agreement exists, you know you are going to apply the smaller of the two rates to be relieved as tax. If double taxation agreement does not exist, and you know it's a Nigerian company, resident outside, domiciled outside, not resident outside, domiciled outside, because as a Nigerian company, anywhere it is, we call it is resident in Nigeria, but domiciled outside. So if it is domiciled outside, all you need to do is you check if the foreign tax rate or the Commonwealth rate of tax does not exceed half of Nigerian tax rates, then that's the foreign tax rate that will be used as relief. But if it exists, if it is exceeding half of Nigerian tax rate, then you use half of Nigerian tax rate. The aim is to put a cap on what to give out as relief as Nigerian, half of Nigerian tax rate. Then when you see that it is a foreign company domiciled in Nigeria, then you use section 33, subsection 2. All you need to do is look for the foreign companies rates, look for Nigerian rates, then look for half of the country's rates. Then all you look at is compare the foreign currency, the foreign tax rate with Nigerian tax rate. If the foreign tax rate is higher than Nigerian tax rate, then we look at half of foreign tax rate as the relief. But if Nigeria is higher than that of foreign tax rate, if Nigeria is higher than that of foreign tax rate, we use half of the foreign tax rate. If the foreign tax rate is higher than Nigeria's tax rate, we will now look at how much does Nigerian tax rate is higher than half of the foreign tax rate. That is what will be used as your relief. So I believe you are going to look over these questions, these 2 or 3 questions you've solved so far, and practice a lot of questions there so that you can be proficient in double taxation agreement. Now, in the exam, double taxation question, as I can say, they come out like between 50 to 70% of the time. So you do well to study this question and see how good you can make of this question. Next week, we are going to talk about another interesting topic which we believe may come out in the exam. The exam is about just 2 weeks from now. So next week, Wednesday, we'll see how we can make you more proficient and more ready to write the exam come the other week, Tuesday. Thank you so much for the time. Somebody said I should recap on the foreign country in Nigeria. There is nothing to recap there. All you need to do is look at this. Just read this. Non-Nigerian company. It states here that if the Commonwealth rate of tax does not exceed Nigerian tax rates, that means if it is smaller than Nigerian tax rates, what will you use as your double taxation relief? You will use 1/2 of the Commonwealth rate of tax. So that means if the Commonwealth rate of tax is smaller than Nigerian tax rate, then use half of the Commonwealth rate of tax. But if it is greater than Nigerian tax rate, then what you will do is to look for Nigerian tax rate minus half of Commonwealth tax rates. Nigerian tax rate minus half of Commonwealth tax rate. The difference is what we use as your relief. So I gave example, if your Commonwealth rate is like 40, of course 40 is greater than Nigeria, you look for half of it, which is 20, and you say 30, which is Nigerian tax rate, minus 20, which is half of tax of the Commonwealth tax rate. So 30 minus 20, you use 10 as your Commonwealth rate. But here, if Nigerian tax is 30 and here is 20, then we said you're going to use 1/2. So 1/2 of 20 is 10. So I believe we got the point now. So I want you to go through all of this. As if you have any question, please feel free to ask me in the WhatsApp class. Sorry, I'm not feeling too fine. As you can see from my frequent going out, sneezing and all that. We want to end the class for today here. I believe we've learned a lot from this 1 hour 30 minutes class or so, and we've covered this topic. So I will try and see if my video, if my audio, if there's an audio for this double taxation. I used to have one before. I will check if it is still there. If it is there, I will send it to the WhatsApp group so that you can also get more tips on how to solve double taxation question. Thank you so much for coming to class. See you in the next class. Thank you so much and good night.